Welcome and thanks for joining this session on choosing the perfect fund of funds for your investment strategy. Over the next slides, we'll walk through a practical framework to identify, vet, and monitor FOFs, focusing on how to set objectives, measure managers, manage fees, and reduce concentration risk so you can make confident, institution-grade allocation decisions. This slide shows the FOF deep due diligence engine and why it matters. Rigorous operational, legal, and performance vetting funnels into selecting underlying GPs, which then flows into an institutional platform with ongoing oversight. In short, the diagram highlights how disciplined screening and monitoring turn limited partner access into affordable, well-monitored exposure that smaller investors couldn't obtain alone. First, define the FOF's strategic role by deciding if it should act as core, satellite, or opportunistic exposure, and align that with portfolio objectives. Then set measurable quantitative and qualitative filters target IRR, acceptable volatility, liquidity horizon, and ESG criteria, so your search has clear paths, fail benchmarks, rather than vague hopes for outperformance. Map the allocations you need across private equity stages, sectors, geographies, and vintage pacing. Then compare those targets to the FOF's model portfolio to ensure mirrored weights and alignment. The graphic also reminds us to run a concentration and overlap check to avoid unintended exposure, implement diversification rules, and actively monitor to minimize correlated risks across the portfolio. Use consistent, measurable manager filters to identify skillful teams. Look for rolling alpha persistently above zero across multi-year windows, a Sharpe ratio greater than 1 for favorable risk-adjusted returns, an information ratio above 0.5 to show meaningful, active return, and max drawdowns below the peer median to demonstrate capital preservation through downturns. When evaluating fees, strip out hidden costs like carry, transaction and placement fees, and compare a transparent net fee model to the traditional structure. Assess whether the total expense ratio is justified by net alpha added, and prefer managers who co-invest, so pay aligns with LP outcomes. The key takeaway is fee transparency and alignment with performance. Score managers using the 4Ps framework: people, process, performance, and portfolio. Look for stable leadership and meaningful skin in the game, a repeatable sourcing edge and proven methodology, disciplined underwriting and risk mitigation that drive consistent results, and a portfolio construction approach that balances concentration limits with upside capture potential. Be cautious when FOFs favor internal family funds. Internal selection can create conflicts, hidden fees, and negative net alpha. Prefer an arm's-length selection process with an external fund universe, independent due diligence and documented evidence, and independent investment committee voting to increase the chance of genuine, fee-adjusted alpha for investors. Post-commitment monitoring is continuous and operational. Track monthly attribution versus benchmarks. Watch for style, drift, key man, or strategy changes. And predefine clear exit triggers for when the investment thesis breaks. If those triggers are met, be prepared to replace managers promptly to protect portfolio alignment and preserve long-term outcomes.